All right, welcome back. Still watching Business Morning live on Channels Television. Now for our next conversation, let's take a look at performance of fixed income market in 2021 and also get an outlook for 2022. See markets responding to rate hikes all globally right now. Let's bring in Omotola Abimbola now, senior investment analyst at Chapel Hill Denham. Great to have you. Happy New Year.
Thank you very much, Ladi, and good to hear from you. Happy New Year.
Good to hear from you too. So how would you describe the performance of the Nigerian fixed income market in 2021?
2021 was very challenging, no doubt about that, particularly coming off a very remarkable 2020 when fixed income investors and traders had a very, very profitable year. But last year was very challenging in the sense that, the entire market had to navigate a very sharp increase in interest rates, particularly at the start of the year. On a year-on-year basis, we observed that, yields across the benchmark bond yield curve expanded by roughly 500 basis points, with the 30-year bond moving up very sharply from less than 7%, to roughly about 13% by the end of 2021. As we know, bond yields and prices, they move inversely. So the upward movement in yields led to a very sharp drop in prices of fixed income instruments. And on a broad basis, based on an aggregate index, we saw that the Nigerian bond market lost about 13% on a year-on-year basis in 2021. After adjusting for interest payments. And a couple of factors led to this, very bearish performance we saw in the market. The first one is that the Central Bank of Nigeria, the CBN, who are obviously the most important player in the fixed income market, they were a bit hawkish in terms of their interest rate policy in 2021, particularly at the beginning of the year. They moved up the HOMO, 1 year yield or 1 year stop rate from about 3% at the beginning of the year to about 10%, towards around February, where it stayed to the end of the year. Now, we also saw that the federal government of Nigeria was very active in the primary market in terms of borrowing because they had a record deficit of finance. So, this very strong level of government borrowing also contributed a bit to what we saw in the market. And from a regulatory perspective as well, we saw, the PENCOM more or less, instructing pension fund administrators to reclassify, their head to maturity and their head for trading instruments. So a cocktail of all these factors, the central bank's activity, fiscal authorities, as well as regulatory, changes, led to a very bearish performance in the fixed income market in 2021. What we think, is that for 2022 as well, the market has to be prepared for what is to come.
Right, and I understand that interest rates increased, but what were the reasons for this, and how did fixed income investors actually, how did they fare in general?
They fared very badly last year. Like I mentioned initially, on an aggregate basis, the fixed income market lost 15%, which is quite a lot. And speaking to the factors that drove these bearish sentiments, it started from the central bank, being slightly more hawkish in the interest rates policy. They raised their own issuance rates at some point. They debited banks aggressively for CRR. Much more later, they began issuing what we call, special bills now in place of HOMO securities, which essentially was the way for them to manage liquidity in the financial system. So that contributed to the reversal of fortune that we saw in the market in 2021. Beyond the monetary authorities as well, from fiscal policy, also we saw the federal government being very aggressive in the debt market due to a record level of fiscal deficit that they had to finance. And on regulatory points as well, we saw a number of regulatory changes as well, that led to the performance that led to the weak performance that we had, in fixed income markets in the year.
All right, now going to the primary market, how did the bearish performance in the secondary market impact, issuance activities in the primary market?
For the primary market, it was a bit mixed. If you look at the Naira primary market, where the governments, corporates and state governments, where they borrow money, we saw a very mixed performance. On the federal government leg, we saw an increase in the level of, government borrowing in the markets, particularly on the treasury bills front, due to the need, for them to, to spend more money on infrastructure projects and also to finance the very large fiscal deficit that we had in the year. Evidently, that led to a significant, crowding out of the private sector borrowers in the market. But we saw that, corporate issuances actually, took the back seats. For commercial papers, for instance, we saw that the volume of issuance and the value of issuance, fell by close to 50%, if not more, in some instances. For corporate bonds as well, we saw that issuance activity also declined significantly. But that's to be expected because 2020 was a very remarkable year. Due to the COVID-19 pandemic, businesses, had to borrow a lot to make sure that their business, remained functioning through the pandemic. So 2020 was an extraordinary year in terms of issuances. And beyond the COVID-19 pandemic as well, in 2020, we also had an extraordinary low level of interest rates, that led to, many corporate borrowers approaching the market. So 2021, with the increase in interest rates environment, corporates, they had less incentive to actually approach the borrowing, to approach the debt market, to raise fresh borrowing. And that led to the significant drop that we saw in the volume of corporate debt activities in the Naira debt market. But if we look beyond the Naira funding market and look at, the Eurobond market, that's where we saw a bit more activity. The federal government, for instance, they made a return to the Eurobond market, where they borrowed about $4 billion, in a triple tranche, offering. We also saw a number of, Nigerian banks and also oil and gas companies, also approach the Eurobond market for borrowing. We had Access Bank, who launched two offerings in the year, to raise money. We had UBA, that approached the Eurobond market, Fidelity Bank as well as Echo Bank. We also saw Seplat in the oil and gas sector also do an issuance to refinance a maturity, that came due, in January 2021. So, like I said, it was a mixed performance. Naira funding market was overwhelming for corporates, but on the Eurobond or foreign currency financing leg, that's where we saw a bit more activity, as several companies, due to the tight FX liquidity we had in Nigeria, many had to look offshore, to get foreign currency liquidity.
Right. And another issue now, President Buhari recently signed the 2022 budget and Finance Act into law. What are the key implications for, fixed income investors as we proceed in the new year?
Okay, for fixed income investors, one thing we are going to be looking at for the new year is what exactly will be the level of federal government borrowing in 2022, because federal government is a very big player in the debt market. They are the largest borrower after the central bank, obviously, in the debt market. So what they do in terms of their, borrowing activity, it plays a big part in the direction, in the sentiment, and of course, the momentum we have in the fixed income market. And based on the Finance Act that was signed and also the 2022 budget, it does appear as if, the federal government, would be looking to borrow a slightly lower amount than what they did in 2021. And that could be a positive thing from the market, from an interest rate and crowding out, points of view. But one thing we have to note is that, the assumptions that underline the 2022 budget, particularly on the revenue front, they are quite ambitious. So we're likely to see a very disappointing performance in terms of revenue collection in the year. and that will probably lead to a supplementary budget being introduced, maybe sometime, towards the end of the year. So, I mean, I would still, I would still, say that, fingers are still crossed on that, but very likely we're going to see a supplementary budget that will lift the level of, planned government borrowing beyond what is currently being estimated in 2022 budget. Regarding tax laws and other things, I mean, the government is still, to a very large extent, still very, very conscious in terms of, raising taxes because the economy is yet to fully recover from the COVID-19 pandemic. So unlike 2 years ago, when we had a very major, tax change, particularly the VAT law, this time around, the two major tax, changes that we're expecting for the year, they are much more lower in terms of revenue impact compared to the 2019 finance bill. So, for instance, the government is planning to introduce a sugar tax, which will be applied to non-alcoholic and carbonated drinks at about 10 naira per liter. So that will lead to a very minor increase in revenue collection. Also, there will be a rollback, a removal of exemption on capital gain tax for disposal, of shares or equity securities, if it's above 100 million naira. So that will also lead to a slight increase in revenue collection. But in terms of, impact, it is much more less, compared to what we had in previous finance had. But I think one major tax policy that fixed income investors and traders will be looking forward to is whether the federal government will renew an exemption, on company income tax, for fixed income securities, particularly government securities and corporate debt. So, about 10 years ago, there was an exemption that was granted, by the authorities then on the payment of, withholding tax and company income tax, on fixed income securities. But that tax policy then had a sunset clause that's going to expire this year, or that has expired this year. So for most fixed income investors, they'll be looking forward to what the federal government will do, whether they're going to grant an exemption, on this particular tax policy or not. But I do think that from an advocacy point of view, it's very important, for the federal government to actually look into getting an exemption, because not doing so will impact on their borrowing costs, as issuers begin to price, as buyers of fixed income securities begin to price this into their valuation of fixed income securities. So from purely demand and supply points of view, it's very important that we grant this exception, and also to make our business environment very attractive, for investors as well. It's very important that we look into finding ways to actually grant or renew this exemption.
That means we can expect a domino effect, from this fixed income tax. Anyway, what is your prognosis for interest rates, moving into 2022?
2022 promises to be very interesting as well. And in terms of, our outlook for the year, I think two major considerations are very important. One is the external financing conditions, which, as we all know, is getting, much more tighter. Central banks all over the world, particularly the major ones in Europe, and the US, they are looking to tighten monetary policy, or let me say raise interest rates, due to the high level of inflation and the strong level of growth they are recording. Now, when all these major central banks are tightening monetary policy, that usually has an impact on emerging and frontier markets due to capital flow, or due to threats of capital flow reversals. So for many central banks, in emerging and developing countries, some of them are already, some of them have commenced tightening their monetary policy by raising interest rates. Towards the end of last year, we saw, the Bank of Ghana, hike its own benchmark rates by 100 basis points. Some other central banks in emerging markets like Brazil, and a couple of others who have also, raised interest rates aggressively. And, what the markets would expect is that the Central Bank of Nigeria will also find ways to tighten the domestic monetary policy as well, to guide against these potential, domino impacts of a much more tighter external financing, condition. The second factor that also, play a role, the direction of, of interest rates in 2022 will be inflation rate. In the second half of last year, we saw a very strong disinflationary, momentum in consumer prices, where headline inflation rates finished the year at about 15%, after peaking at more than 18% around May 2021. So the outlook for this year is that we are still going to see a slight, a much more, in terms of momentum, the pace of disinflation rather is probably going to reduce, but very likely in Q1 2022 we're still going to see inflation rates continue to head downward. But towards the end of the year, we think that this should have bottomed out at some point. Okay. And with so many, so just to summarize, the outlook is that in the first quarter of this year, due to high liquidity in the financial system, rates are going to remain very low. But towards the end of this year, due to expectation of a tightening of monetary policy by the central bank, we're going to see interest rates actually head northward once again.
Okay, I guess investors have a lot to look out for in 2022. Omotola Abimbola, thank you so much for coming on the show. Investment analyst at Chapel Hill Denham. Great to talk to you. Enjoy the rest of your day.
And you too. Thank you.